Story Demystifying Debits and Credits. Once upon a time, in the bustling town of Accountingville, there lived a married couple named Debit and Credit. They were a dynamic duo, always working together to achieve their goals. One day, they decided to embark on a new adventure and start their own business, a charming little gourmet hamburger restaurant called The Balanced Equation. Debit was the go-getter of the couple, always on the lookout for new opportunities. He had a knack for finding the best suppliers, negotiating deals, and ensuring that the restaurant had everything it needed to thrive. He was the master of getting things for the business, such as assets, incurring expenses and costs for services and purchases, and getting sales. His friends nicknamed him Got. On the other hand, Credit was the generous and giving soul. She had a natural talent for creating a warm and welcoming atmosphere in the restaurant. She greeted customers with a smile, provided exceptional service, and made sure everyone felt valued and appreciated. She was the expert at giving to the customers and suppliers. She gave back some of the assets and gave out some IOUs, amounts owed, for the stuff that Debit got. She also had a nickname, Gave. As Debit and Credit embarked on their entrepreneurial journey, they quickly realized the importance of keeping their getting and giving in balance. They knew that for their restaurant to succeed, they needed to carefully track their financial transactions and maintain a clear picture of their business's financial health. That's when they discovered the magic of double-entry bookkeeping. They learned that every financial transaction had two sides, just like their marriage. Debit represented the getting side, while credit represented the giving side. Every time Got acquired something, Gave also gave something. This is actually the definition of a transaction where you get something and also give something. This also kept that thing called the accounting equation: assets equal liabilities plus owner's equity in balance. Debit and Credit set up their bookkeeping system, creating a chart of accounts to track their financial activities. Debit opened accounts for purchases, expenses, and assets, while Credit opened accounts for sales, revenue, and liabilities. Each transaction they recorded had a debit, Got entry, and a corresponding credit, Gave entry. For example, when Debit purchased fresh ingredients for the restaurant, he recorded the expense as a debit, Got, in the purchases account. At the same time, Credit recorded a credit, Gave, to a liability account. This ensured that their getting and giving were always in balance. As the restaurant flourished, Debit and Credit continued to use double-entry bookkeeping to maintain financial harmony. They recorded every transaction, from burger sales to supplier payments, with precision and accuracy. This allowed them to generate financial reports, analyze their performance, and make informed decisions for the restaurant's growth. Their commitment to keeping the getting and giving in balance paid off. The Balanced Equation became a beloved spot in Accountingville, known for its delicious food, friendly service, and a warm atmosphere. Debit and Credit's business thrived, and their restaurant became a symbol of financial harmony and success. And so, Debit and Credit's journey as business owners taught them the importance of balance, not only in their financial transactions, but also in their partnership. They realized that by working together, keeping their getting and giving in equilibrium, and embracing the power of double-entry bookkeeping, they could achieve great things and create a thriving business that brought joy to their community. So, what did we learn from this story? Let's associate the debit and credit terms with terms that you are more familiar with: Got and Give. A debit represents what you got, and a credit represents what you gave. We'll use some example transactions to illustrate. Got represents a debit and Gave represents a credit. Transaction obtained a bank loan business. Got cash and gave a promise to pay debit cash account and credit loan payable account. Transaction incurred an expense, utilities, or bought inventory. Business got a service or inventory and gave cash or a promise to pay, debit an expense or inventory account, and credit cash account or accounts payable account. Transaction made a sale business. Got cash or a customer's promise to pay and gave a service or product, debit cash or accounts receivable account, and credit a sales or service account. Transaction received customer payment. On account business, got cash and gave a decrease to the balance owed by customer debit. Cash account and credit accounts receivable account. I think we could have made the debit and credit concept easier if we had used the term got and gave instead of debit and credit. How about you? Well, if all else fails, you can always use my debit and credit cheat sheet from my Bean Counter website or review debits and credits discussed in my Bean Counter tutorials.